Okay, welcome back. And the other big story which will likely play out today is that Glenmark has signed an exclusive distribution as well as supply agreement. And this distribution and supply agreement is with regard to a drug in the oncology space, and it's a specialty drug, and it's the first of its kind, especially for a Glenmark, which does generics, which doesn't do specialty much, and the agreement has been signed with Jiangsu Hanzhou Pharmaceutical Group, and it's obviously a multi-million-dollar agreement, but it could go to as high as $1 billion. The agreement itself, if one were to add commercial milestone payments, etc. It's a tiered royalty structure in terms of the licensed territories with which they have announced this agreement with, and it's and of course it is for certain territories only: Middle East, Africa, Southeast and South Asia, Australia, New Zealand, Russia are just some of the countries, including some of the Caribbean countries included as part of the agreement. So this could be big for Glenmark, of course. Amnish, do you have a view with regard to what this opens up in terms of opportunity for Glenmark? Because it's first of its kind, specialty, and it gives Glenmark an important foothold in some of these markets as well.
From here because it's not rich. But having said that, the entry into, you can say, the specialty market definitely will be positive for the company because it opens a new growth avenue for them.
Okay. Amnish, your audio wasn't clear. Could I request you to repeat that?
So, DMart, we don't have a firm coverage on the company, but having said that, entry into the specialty segment, which is fast growing, which has got high profitability and margin, that is definitely positive, and it will open new growth avenues for the company.
Okay. All right. So you'll have Glenmark and focus on the back of that. Kunal, any view with regard to any of the pharma names, Glenmark in particular, on charts? Any of them looking interesting to you?
Yeah, even Glenmark has been a decent stock. YTD basis also, I think when you look at this, is the third consecutive year for Glenmark Pharma where the stock has done reasonably well. Yes, it's cooled off from the recent highs of 2,200, 300 for Glenmark Pharma, but then that's how it's been the case for many of the pharma counters where, mid-month or, second half of this year, you've seen on the back of expectations on the global news, etc., that the stocks have gone through a 10-15% kind of a broad correction. But the chart setup for Glenmark Pharma has been quite positive. In fact, on the very recent charts, the last 1 month or so, the stock was holding on to that 1800, 1850 support multiple times. You look at the weekly charts and you can literally draw a strong support trend line at that 1850 levels or for Glenmark Pharma, and the stock apparently for the last, I think, for that period of 5-6 weeks on a trot was holding on to that 1850 levels for the stock. So that, I believe, is a crucial support for Glenmark Pharma. That retest or the mean reversion is completed, and now I believe that the stock should be on course of continuing from where it left off, say mid part of this year.
Okay, and I don't know, Amnish, if you have a view with regard to Ola, Bhavish Agarwal selling, but clarification coming through after that saying that the sell, the quantum sold of around 90 crore is going to be used to revoke some pledges with regard to loans taken. Positive, negative? Are you constructive, Ola? That 7% downward move yesterday, is this an opportunity to buy?
You see, my feeling is that Ola is not now in a situation like it used to be when it got listed. Today, the space has become very competitive. You have got TVS and Bajaj of the world, which have got very deep pockets, which have made big inroads into the company, and the volumes of Ola are nowhere near they used to be. And it is not able to, you can say, get back those volumes. So the entire, you can say, dependency is now on the, you can say, the battery business and things like that. So particularly on this event, I think it's very, very difficult to say that how, because these are all, you can say, your stake sales by the promoter and all these are, you can say, having short-term impacts on the same. But fundamentally, it might give you, you can say, some upticks in between here and there. But definitely in the longer term, I think I'm not very positive on the name.
Okay, so that's the take coming in on Ola Electric. A bunch of other stocks that are going to be in focus, but first I want to throw the spotlight on Avenue Supermart or DMart. And why I'm highlighting this today is because today we have seen a Goldman Sachs note coming in on this stock, which is exactly opposite of the CLSA note that we saw yesterday. So that's quite interesting. The two narratives and the perspectives that are building on the street for DMart. Let's address the Goldman Sachs note first, wherein they continue to be negative on the stock. They've maintained a sell rating with a target price of 3,425 rupees per share. That is maintained. Earnings downgrade cycle continues to be weak while valuations continue to be elevated for DMart is what they believe. They also believe that the company faces heightened estimates and execution risks as well. Now remember, a bunch of these brokerages have already trimmed the FY26 consensus estimate. Goldman Sachs has done that to the extent of 9.6% on a year-to-date basis, and they believe that despite this, to meet the FY26 consensus, the second half PAT needs to grow 25% for DMart, wherein for the first half it's grown only 2%. So they're implying that this could open the doors for further downgrades for the stock as well. So is weak and will continue to be weak is the outlook coming in from Goldman Sachs on DMart. Also, they're saying that Blinkit's NOV, which is the net order value, is expected to exceed Avenue's total sales in FY27. That is a big thing that they're highlighting, because remember, now if you talk about the CLSA view, CLSA has very prominently yesterday said that despite the emergence of quick commerce, DMart seems to have strong moats to defend its business and to grow its business despite quick commerce and new players entering into that segment. So that is a contrast coming in. And also on the rating front, CLSA, remember, yesterday rated DMart as a high conviction outperform, wherein they believe that once their store expansion plans are done and they're stable on that front, the free cash flow could turn positive. That is not something Goldman Sachs agrees with. In fact, it is even doubtful that DMart will meet its store addition guidance at all for this year. So very contrasting views coming in and very interesting over here. Amnish, which school of thought are you a part of right now? Are you positive on DMart given the kind of pullback we've seen, or is it more of a wait and watch approach that you are adopting at this point?
See, we are, I would say, we are not positive on DMart from quite some time. And the reason for that is that, first of all, the competition from quick commerce has been rising. Although one can say that the quick commerce directly competes with the DMart Ready, which is not a very big part of the sale, but definitely there's a section of consumers which gradually and slowly is moving towards quick commerce, and that is actually impacting the sales of all the brick and mortar retailers at some point of time. The second is that the India is a very unique country, because globally, if you look at the quick commerce is not that successful, but given the, you can say, the low labor costs and the availability of gig workers in India, the economies of scale and you can say overall economies of quick commerce business, I think they are improving over the past couple of years in particular. Now, with the lower capex relative to what a store of say DMart requires and rising throughput, so that becomes a very viable option. So that has actually resulted in, so you see, there are multiple reasons for that. Say, for example, the sales mix has deteriorated over the past few years. And now structurally, DMart doesn't seem to be in a position to have an EBITDA margin of say more than 7.5%, where at one point of time they were at 8.5%, 9% kind of a range. Plus, you open one store, you end up spending say more than 40 crores in the overall capex. And over the years, the overall spending on the acquisition of land and capex has been going up. So they are generating cash flows, but the kind of expectations which the state is building up of opening 60 stores, 70 stores, so that is something which I think it is not possible from their own cash flows also. But having said that, we might have seen already the bottom in terms of margins post the correction which has happened over the last year and a half. So the growth rates can be higher than what we have seen, but I don't think they could be anywhere 20%, 25%. I think as of now, the visibility seems to be more like, you can say, mid-teen kind of a growth from here on. So again, I would say not a cheap stock, not overly expensive, but at the current valuations, I would be rather on the sidelines and not be keen to, you can say, buy on the stock, except when I'm looking for, say, some sort of, you can say, small time, you can say 5-10% kind of an uptick due to trading difference.
Okay. All right. Keynes Tech is the other one. They've signed a partnership agreement, in fact, which accelerates their OSAT setup as well as capabilities going forward. Keynes at all on your radar, Amnish, and what this partnership could entail, in your opinion?
You see, Keynes Technologies is one of the larger players which is setting up these source and semiconductor related facilities, and the stock has got significantly turned down compared to the past few months. The accounting and you can say issues. Now, you see, the semiconductor industry in India is, I think, quite missing. And for all these players, first of all, you can say setting up the facility and then scaling it up requires a lot of, you can say, lot of patience, and it will take it some time. So anything which you can say accelerates that actually will be a positive for the company, but how far it will start impacting the numbers of the company over the near to medium term is something which we'll have to wait and watch out for. So the stock has corrected, but is it overly cheap? I don't think so. It will all depend upon how they execute, how the balance sheet pans out over the next, say, year and a half.
Okay, and Amnish, your view on some of the other players from this EMS basket, perhaps a Syrma, how is that looking to you?
The Syrma is among the better players because if you look at the past, you can say 2-3 quarters, the margins have been better than most of the other players. They have been able to protect their growth as well as the margins. So I think Syrma, stands out in the entire basket. But in terms of upside, I think you see the kind of valuations all these semiconductor or these OSAT players they have started getting, say 6-8 months back. I think that those are the numbers which are not likely to be repeated because there is something which is called reality and there is something which is called hype. And when the things start, you can say getting back on the normalized levels, I think your valuations take importance. Now, relatively, Syrma has done better than most of the other counters, and the growth has been on the positive side. If they execute well, still there could be some upside in the stock.
Okay, all right. So that's with regard to a Syrma as well. You know, some of the railway counters and even one or two of the infra counters and Ahluwalia contracts, for example, won an 888 crore order yesterday. Now, let me just contextualize this. In terms of the materiality, Ahluwalia contracts is a 6,400 crore market cap company, 4,300 crore in terms of top line. So this might add significantly in terms of the way one looks at the stock because it's obviously a large order win. It's around 8 to 10, 11% margin is what it makes on the business. So broadly, if once this gets executed, it's around 80 to 100 crore of EBITDA, which gets added in terms of the cash flow that comes into the company, which is a key positive. Amnish, how do you view some of these plays? And also let me welcome on board Rajesh Palvia, Head Technical and Derivative Research at Axis Securities. But Amnish, how do you view some of the plays with regard to railways where you are seeing a pickup with regard to orders? Also Ahluwalia, for example, with regard to infrastructure, because some of these would well come into play as we run closer to the budget, right? Some of these may well be in the picture.
You see, if you look at the EPC industry in the last 2-3 quarters, they have not done anything great because the order inflow for many of the EPC players has been pretty weak. That is one. Now, secondly, when it comes to your budget in particular, you see, this year the government has increased that budget by around 11% on the last year's base, which was more or less, I would say, flattish kind of a number. And the first 6 months, the execution was very, very strong. So the months running up to March, they are not likely to be anything great, and it depends upon you can say what are the numbers for the next year. Now, if the numbers show an increase of say just around 10-12%, then it is not likely to be anything which is very, very significant for all the EPC or capex related companies. But having said that, one needs to look at that these capital expenditures by the government, they continue to be, you can say, getting shifted from one segment to the other. So, for example, a few years back, roads was going very fast, and this was your rural electrification, then your pipe water. So the after a while, when there's a, you can say, accelerated capex on a particular segment, we usually see that after that the government also reduces the, you can say, the spends on that, and it goes to the other segment. So due to that, I think one needs to look at in all the EPC players which segments they are catering to, and what is order inflow in that. But having said that, last 6 to 8 months, the orders have been in the low side, and I think in going up to March, I expect the orders for most of the EPC players to start pouring in as the fresh allocation will start coming in, and you can say the government also starts looking at FY27. So that could result in some sort of, you can say, the increased investor interest as well as excitement in all the EPC players.
Yeah, so interesting. Amnish, thank you so much for joining us. We'll let you go on that note. Rajesh, let me take the question.